Good morning, everyone. Friday, November 11th. First of all, happy Veterans Day. Second of all, welcome to Three Things with Spyglass Lending, where we go a little bit deeper into the mortgage industry, a little bit further behind the curtain than the usual rigmarole you hear. And today, we're going to keep it very simple. I just want to show you what's happened to rates in a very different part of the industry, not the standard 30-year fixed or 15-year fixed, or even these 5, 7, and 10-year ARMs that everybody's used to. This is about investment property, and this is for real estate investors, or if you're not a real estate investor, and everybody often thinks that they are, you might just get a kick out of this as well. So let's start with number one, private money. Where do we stand these days on rates? Because not that long ago, really just a few months back, a lot of the fix and flip lenders were still giving it away at 6.5%, 7.5%, 8% money, especially to experienced developers. Guess what? Even the experienced developers have gone up above 10% now. That's right. When I first started in this business back in, call it 09, 2010, 12% interest-only rates were all the rage for fix and flippers. We're back pretty close to there right now. So a lot of this money is back over 10% for the experienced people. The ones who aren't that experienced are back 11 and even 12%. I don't even want to tell you what it looks like in second lien position. That's first lien position, and the leverages have come back down. We've talked about that before, meaning you used to just have to put down 10%. Now a lot of the institutional funders want you putting down 20%, even more, to do a deal, whether that's flipping or new construction. However, there are certainly still institutional funders out there doing 10%. A few that I work with included where you can put down as little as 10%. Secondly, DSCR. Again, we've talked about this before, but what does that stand for? Debt Service Coverage Ratio. These loans were massive through the pandemic. Why? Well, they're long-term financing for real estate investors without showing tax returns, without showing W-2s. Debt Service Coverage Ratio. As long as the cash flow from the rent, single family, small balance multifamily properties, were covering the expenses, principal, interest, taxes, insurance, and whatever else you might have had, management, if you're covering utilities, whatever that is, as long as the ratio was 1-to-1 or around there, because you can manipulate a lot of these loan products, then yeah, those loans were being made really good, low interest rates on stuff like this that just wasn't available before. I'm talking about 4s and 5s and maybe into the 6%. Well, guess what? Now we're looking at 8, 9, 10%. That was old hard money, private money loans. That now applies to the DSCR product. Not a tremendous amount of activity going on in California right now because the LTVs are so low. What do I mean by that? Well, cash flow doesn't necessarily make sense at 70 or 75 or 80% LTV anymore for these loans. And that's hard in the state of California because people often buy for appreciation more than they do cash flow. So a lot of the loans and the loan-to-value ratios are 60% or below on this product. Well, that doesn't often compute to a lot of people who own this product or are trying to buy long-term rental. So it's a much bigger product on the Eastern Seaboard, but it's still decently sized in California, especially those who own long-term rental properties and want to cash out of it because it's easy to cash out again without having to show tax returns, no seasoning issues, and you can make the loans to entities. You're making it to LLCs, you're making it to S Corps. You don't have to do the same thing where you're doing to a personal name or taking that of the entity, doing personal name like you would on a conventional mortgage. And finally, lastly, bank statements. Well, what do I mean by that? Bank statement loans. Again, not tax returns, not W-2s, but because a lot of people often run a lot of expenses through their businesses, and that's not showing up on tax returns on the other way. Again, but these people certainly make a lot of money and they're well qualified for a property, so they use bank statements. They use the last 12 or 24 months of bank statements, a personal bank statement or a business bank statement, and you're qualified that way. The money coming in against the expenses going out certainly shows a really good debt to income coverage ratio on that. Again, that's really just DTI, debt to, not to be confused with DSCR, but debt to income there does make sense if you're just looking at the money that comes in on the bank statements. Again, these rates, which were once a lot more attractive compared to a qualified mortgage, which again, as we know, on the 30-year is 7% or around there or a little bit higher these days, though this week's been a little bit of a reprieve. Bank statement loans, you're going to see more like 8 and even 9% money. And this is for standard buyers. Forget real estate investors for a second. A lot of standard buyers just use bank statement loans, and they are unfortunately stomaching 8 and 9%. But again, that still does make sense for a lot of people. You're also paying a little bit of a premium for those deals. Oftentimes, it's a no-cost loan on a 30-year qualified mortgage, but with bank statements, you might be paying a little bit more either in the interest rate or an origination fee. But that's what's going on in the market, outside of the standard 30-year mortgage. That's what's happening with the rates, and I appreciate you joining me. This has been 3 Things with Spyglass Lending. We'll see you next Friday. Thank you.